Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at Tasty Live. Welcome to the show. Interesting day in markets, interesting 48 hours in markets here today. We're going to really quickly take a look at where we've been left here in the wake of today's US CPI release. That, of course, has continued to shape this narrative in the wake of last week's failure of SVB and Signature banks and the fallout from that on all manner of markets and Fed policy expectations. And then we're going to look at what's going to be the thing that shapes this story next and what may be a new headache for the Fed. Obviously, they have plenty of headaches to worry about already, but we do have another one, and this is a story that we've been following for a while. The idea that the reopening in China, among many things, among regional bank failures and inflation that won't come down and all other things, a source of consternation for the Fed as it attempts to get the U.S. economy on a pathway to the Fed's 2% inflation goal. So let's first kind of get a lay of the land here. This is where we have been going, and it's important to consider that it's still where we are. So from February onward, we still have a U.S. economy that is doing meaningfully better than economists expect. Looking at this data from Citigroup, we continue to see U.S. economic data outperforming baseline expectations, those expectations as polled by the likes of Bloomberg, Reuters, and other aggregators from vast pools of institutional economists and other market watchers to really get us the kind of things that we look at when we say, oh, well, XYZ economic data or earnings release or anything else for that matter was expected at X and came out at Y. So that X is the pooling of those expectations by these aggregators. This data from Citi says we're going to look at how the data actually performs relative to those expectations. And then what we're going to do is we're going to scale that by how reactive markets are to surprises and give you an index to give you a sort of sense of how is the overall flow of data doing relative to the overall perception. And you can see here from February onward, the data has been increasingly doing better, which means economists' models have been increasingly too pessimistic about where the U.S. business cycle is. The upshot of that has been the creeping higher of inflation expectations. So the yellow bars you see there are the break-even rate. That's the difference between nominal and real rates on U.S. Treasury securities. Nominal rates minus real rates give you the magnitude of the inflation adjustment that's priced into bond markets to get you from one to the other. And you can see here that going out to the 2-year, which essentially gives you about where the Fed's policy outlook window is, you get still, over the past 2 months or so, a 3% inflation rate, give or take, on average. It was 3.2 in February. In light of recent events, it's come in a bit to 2.8 in March, but nevertheless, averaging about 3. And if you look at where actual inflation measures are, obviously we just saw CPI register for us here today. As you look at how these numbers actually play out, what you're left with is about a 2-month lag. So these expectations anticipate where actual inflation goes with about a 2-month lead, to put it another way. So what this is telling us is that inflation is not beaten, that the market is telling the Fed, you have not done enough tightening to get to where you need to go. If these numbers were at a 2 handle, then you did, but they're not, so you haven't. So you need to keep going. We see, obviously, the dramatic impact that's been had in the past several days from the collapse of SVB and following on from that, Signature Bank. So if we look at here, we saw that build in U.S. economic data start in February. We saw the build in inflation expectations follow in February and March, as we've just seen. We can see the orange line is the 12-month outlook on what the Fed funds rate is going to be. And you can see from February on, it starts moving higher. But then as financial risk surges, that's the blue line there, with this SVB turmoil, so too Fed rate hike odds collapse. And so now we see a dramatic readjustment in markets that essentially says, okay, you, the Fed, if you don't want any more bank failures, you're going to have to back up here. You're going to have to admit that you've over-tightened, which is interesting as a conflicting signal because, again, clearly here, what we're saying is the Fed has not over-tightened. As a matter of fact, it's under-tightened and needs to do more relative to where the economy is. And so today, we get this CPI number. It comes in basically in line with expectations, still gives us about a 6% handle on inflation. And so what you get then is a shift in the yield curve that moderates the level of consternation immediately after SVB. So what you see on this chart here in the solid is the actual yield curve as it looks today. Then above it is the yield curve as it looked following February's FOMC. So in other words, you can see here that the setting was more hawkish, and then in light of recent events, it's become less so. But then underneath that, you see where this curve was even yesterday, the first full day after SVB's essentially immediate aftermath. So we learned over the weekend, obviously, that depositors would have access to their funds thanks to some creative policymaking by the FDIC and indeed the Fed. We saw that we were not going to have a taxpayer funded bailout. Here, the UK arm of SVB was quickly snapped up by HSBC, making those depositors whole. And so we have a situation then where the Fed curve has now moved a little bit off those extremes. Rates have meaningfully increased over the 3-month window and especially the 6-month window from about 4 to about 4.6. So a meaningful change here, even in just one day. So the market seems to be, again, looking at what the Fed is facing with inflation and saying, hold on, we just had what looks like, from what policymakers are saying, an episodic period of stress, not a systemic collapse of any kind. The Fed was able to deal with that, along with the FDIC, in a way that ring fences the situation, which of course is what the Fed has been saying all along, that as it tightens, things won't be smooth, things will go bump in the night, essentially, and that they have the tools to address that. This was an example, a case in point. And so as we get an inflation number earlier today that still feels hot, the markets look at the overall landscape and say, maybe we overdid how much the Fed was going to go and dig its head into the sand here. Maybe actually the inflation fight continues, albeit not as robustly as maybe it would have were we looking at this 2 weeks ago, a week ago. And so if you look at the overall breakdown in expectations, now you have a rate hike fully baked in between March and May. So you can see come May, we're 32 basis points higher than currently. If you look at that implied rate delta, that 0.32, that tells you we're at least 125 basis point hike in, and maybe a little bit more. Come June, you can see you're flirting with basically having the one hike at that point. Where things start to get interesting is come December, that hike has been given back. So you can see, first of all, we're off to where rates are currently by July. So in other words, March, May, we're 32 basis points over where we are now. July, we're exactly where we are, 0.14. In other words, nothing has changed, according to the markets, come July. So we've already given back that hike. And then come December, we've given away another hike. So we're actually net down one hike's worth on the year. And as we get into January, we start to flirt with the idea that maybe come January of next year, one more hike comes off the board. You can see there the implied rate delta down 40 basis points. So essentially giving us a sense that by then we're looking at almost a 50 basis point cut priced in. So we can say that in a cumulative sense, by then we're looking at almost a full two cuts, essentially at the calendar year turn. And while that's a bit more hawkish, or at least a bit less dovish than it was yesterday, it is nevertheless a far cry from where we were, let's say, a week ago, where we were still seeing rates well north of 5% come about the end of the first quarter 2024. Now, this, of course, will continue to evolve. And if you look at the situation currently, you can see it begin that way. So this is where the current peak in rates ostensibly is, between May and June. So again, we just saw that in March, May, we're going to get a hike. June, July, there's a top. And so June is where that 4.8 peak in rates that you can see shows up. That's already a hair lower than the May rate of about 4.9. So that's basically a peaking mid-year. And so if you look forward where May and June are, you can see just over the course of today, they've perked back up a bit, having aggressively declined going into today's session. Now, one headache more that emerges for the Fed in all of this and complicates the Fed's calculus further is China. And we're going to get a bit more data on this today and see to what extent this makes the job even harder for Jay Powell and company. There's a big data dump today from China, February industrial production, retail sales, fixed asset investment, excluding rural investment. So this is essentially what you might call investment in the normal GDP calculus for the U.S. economy. And then the jobless rate. And it's a hodgepodge of expectations here. So we're expecting to be weaker on industrial production, ostensibly because of softer global demand, but stronger on retail sales, ostensibly because the reopening continues and people are finding more vigor. Fixed asset investment a little bit lower, but the jobless rate a little bit lower as well. And so it's a kind of give and take here. We also have U.S. retail sales, which was a big market moving indicator last month, having meaningfully outperformed expectations. Let's focus on China first. It's fairly straightforward what's going to be the calculus here for retail sales. If it comes in hotter, that of course encourages a further adjustment in Fed policy odds back to a less dovish setting. And as we've seen, it has been the case that U.S. economic data, the first chart that we saw in this session here, has tended to surprise higher relative to expectations. So if we get another meaningful upshot here on retail sales, the conversation about the Fed could well continue to shift away from SVB inspired extremes back to something more familiar before that issue. It's the China data that's really important here. China is the world's second largest economy. The reopening there is a major consideration for growth and inflation everywhere because of the size that we're talking about. If we look at where the markets have expected China to perform, what you see here is the yellow or the orange line is China's version of the economic surprise index. And you can see here, it has been moving meaningfully higher as of January. In December, we got the reopening. There was another hump in COVID cases there as the virus basically burned through a now reopened economy and did a bit of catch up that was held back by quarantines and lockdowns before. With that reopening and with that sort of adjustment kind of running its course, it would appear by around mid-January, you now have what is a steady build in the performance of Chinese economic data relative to forecasts. In parallel with that, economists have notched up their expectations for growth in China by a significant quotient here. So we've moved from about 4.8 for 2023 real GDP growth to 5.3. So the markets are clearly taking notice that the economy is doing better, and they're clearly adjusting expectations accordingly. Where we haven't seen this show up yet is in expectations for 2024. We can see a modest rise from about 4.8 to 5 on those expectations, but so far that's been flat. Nevertheless, it does look like the markets think the situation is improving in China, and there's good reason to believe that story. So looking at official PMI data, you can see the latest numbers well above the 50 make or break line, as we've talked about before in the logic of PMIs. 50 is above the key decision line here and below. If you're above 50, you're growing. If you're under 50, you're shrinking. The further you go above, the faster the growth. The further you go under, the faster the shrinking. So you can see here for official PMI data, the latest round, we're well above 50 and accelerating in that direction across services, across manufacturing, and the composite of the two. If you look at a private sector estimate of the same data, let's say you're dubious about numbers coming out of the PRC's officialdom, and you instead want to look at a private sector version. Well, there it is from Caixin and S&P Global. And you can see here, again, numbers increasingly above 50, seemingly a recovery afoot. You can see it in anecdotal and high-frequency data. This is a 20-day moving average of the traffic, the metro traffic, in the top 5 cities in China. Naturally, you would expect that with reopening, more people would start moving around, economic activity would pick up. That's exactly what you're seeing here, a dramatic pickup in metro activity in these areas. So even at a very baseline level, you're looking at an economy that seems to be coming back alive, But this is not a uniform set of signals. From a monetary perspective, this is something that we've also been looking at over the past several months. You can see that the money to power the recovery doesn't seem to be moving. One would think that if you had this robust recovery, more investors outside of China would want to participate, and more investors inside of China would want to deploy capital elsewhere with this new vigor in front of us. That is not seemingly occurring. Volumes on the Shanghai Hong Kong Stock Connect, which allow investors on mainland via Hong Kong to invest out, and investors globally, again via Hong Kong, to buy shares listed directly in Shanghai. If we look at the turnover there, it hasn't really gone anywhere since the Fed started this tightening campaign. You can see the peak in turnover there is around middle of 2021. So there's still a good bit of risk aversion that's baked into here, it seems, and it doesn't appear like there is a strong monetary impetus behind this recovery. It doesn't seem to be seeing money be deployed. And when you look at the CPI numbers from last week, you, of course, saw vast disappointment. The expectation was that you were going to be at 1.9. We ended up at 1. And you can see that inflation came in both on the critical food component and CPI excluding food. Food is by far the largest share of Chinese CPI at about 20%, about a fifth. So what you're looking at here then is a bit of a conflicting sort of indicators. You can see also that looking at what all of this has meant for the actual credit structure in China, its yield curve has actually shifted lower over the course of this reopening. So the reopening occurs at the beginning of December. You can see that's that dotted line there. And then, of course, there's the current yield curve, and it has become less steep as the economy has reopened, not more steep, which is what you would expect. So on the one hand, you seem to have robust economic activity, as we've just seen. On the other hand, you seem to have no pressure on rates and nothing much happening in terms of the velocity of money changing hands and in terms of inflation to follow. This is very, very interesting because to the extent that this is lagged, to the extent that inflation will follow from economic activity picking up, and we are still in the early innings of that economic activity rebounding, we could be looking at what will soon become another headache for the Fed because, of course, China is the world's largest importer of most commodities. And if, in fact, money is going to start to change hands here to power this recovery, that might very well be a pull on commodities at a time when that is a key input into the Fed's calculus. You can see that while its actions to cool economic activity certainly have been part of both reducing inflation and reducing commodity demand, surely at least a significant bit of that commodity demand coming off, and thereby the commodity price index that you see on your screen here in the blue coming off, has been the absence of Chinese demand while they were on lockdown through most of last year. Well, they're not on lockdown anymore, and they're apparently accelerating if we look at the PMI data, the metro data, et cetera. To the extent that this is going to create a pull on commodity prices, it might also undermine the disinflation that the Fed has been able to achieve so far, which alongside break-even rates going up, U.S. Economic data registering better than expected, encouraging them to do so, seems to suggest inflation is still very much a problem for the Fed, and part of it could even become imported inflation from what a China reopening could mean, which in an environment where the market is convinced that the Fed has already thrown in the towel because of SVB, might make for a very rude awakening if the data that we see tonight out of China is going to make like the data we've seen out of China for the past month and a half and surprise higher, because that would imply that commodities demand is probably coming. That will probably be a new headache for the Fed going forward on the inflation front, and yet another reason why, come the policy announcement next week, we may not get a Fed that blinks. On the contrary, we may get a Fed that is beckoned to stick to its guns lest it lose credibility in the face of what reality has actually presented it with. And that's not anything that the Fed is in the market to have happen, which means that if we continue to get the kind of data flow we're getting, U.S. and China, and tonight is going to be a big test for the Chinese piece of this, then we could get a Fed that's much more hawkish than market expectations now anticipate. That doesn't mean hawkish, but relative to what we're looking at now, not really a stretch, which would imply a significant downshift in shares, a significant upshift in the dollar, lots of trouble for gold, and a big rebound in yields from those SVB panic lows. The corollary to that, of course, is the rally in the bond market that everybody's been gearing up for may be delayed yet. And that is Macro Money for today. Thank you very much for joining me. We are here Monday through Thursday every single week, right after overtime, with our good friend Chris Vecchio, head of Futures and Forex here at Tasty Live. You can also catch me Sunday evenings with Tom and Tony for First Call, Fridays for Future Power Hour with Chris. And outside of the shows, if you want to hear me opining on markets, you can do so via Twitter at Ilya Spivak. Thanks very much for joining, everybody. Godspeed out there. See you tomorrow.